Welcome to my channel. I'm Scott, and in this video I am going to walk you through the process of valuing Falcon Minerals stock by analyzing their financial statements and dissecting their financial ratios so we can determine if it's a buy or a sell. Falcon Minerals is an oil and gas company that owns mineral rights in the Eagle Ford Shale. The Eagle Ford Shale is the second largest oil field in North America and also the lowest cost and most active property. It covers 13 million surface acres and has 18,000 producing wells. ConocoPhillips and BP are currently extracting oil there. Falcon owns 256,000 acres in the Eagle Ford Shale region, located in the following Texas counties: Karnes, DeWitt, and Gonzales, totaling 2,087 wells. The company claims its assets are among the most valuable in North America, with operator break-even costs under $35 per barrel. That means as long as oil stays above $35, this company can make money. Also, its assets include royalties related to approximately 80,000 acres in the Appalachian region, including Pennsylvania, West Virginia, and Ohio. Its assets consist of royalties relating to 541 drilling units. The average net daily production attributable to all its land is 4,566 barrels of oil equivalent per day. Just in Eagle Ford alone, it can pull 4,000 barrels of oil equivalent per day. Its revenue comes from royalty payments it receives from its operators based on the sale of oil and natural gas production, as well as the sale of natural gas liquids. In 2020, 75% of its revenue was from oil and condensate sales, 18% from natural gas liquid sales, and 7% from natural gas sales. Falcon was funded by a SPAC, a special purpose acquisition company is formed to raise money through an IPO, then acquire a private business to help them go public. This is also known as a reverse merger or reverse takeover. In 2018, the merger was completed and Falcon received $115 million in cash proceeds. The SPAC that acquired Falcon was Osprey Energy Acquisition Corp. The company is headquartered in New York, and was founded in 2016. It trades on the Nasdaq and Deutsche Börse. Let's get started with the model. This is a microcap company, 268 million market cap. They're trading at $5.72 a share, and they have 47 million shares outstanding. Let's look at the financials. The way you value a company is you estimate the free cash flows into the future, and then you discount those numbers back to today's value. That's what we're doing in this video. And free cash flow is cash flow from operations minus capital expenditures. So they do have positive free cash flow every year. It did peak in 2018. Net income is the profit or loss on the income statement. It's revenue minus expenses. And that's also positive every year. Revenue is the sales for the company, and that was $97 million in 2018. It did drop in 2019, which is concerning. It dropped a lot in 2020, which is expected because the price of oil dropped so much. But it is coming back up in the trailing 12 months at $57 million. This is the company's income statement. The top line is the revenue, the sales. Then they have a bunch of expenses. The first is production and ad valorem taxes. Ad valorem means their proportion of the expenses related to the royalty properties. They had a couple million in marketing and transportation. The most is the amortization of the royalty interests. That was $14 million. $12 million in G&A. This is mainly payroll. Since they own the royalty rights, their expenses are pretty limited. They don't have to actually pull the oil. They just collect a proportion of the profits. So they should be profitable most years because their expenses are pretty limited. It looks like they issued warrants, which are long-dated options. It just gives the warrant holder the option to buy the stock at a certain price. So they have to market those warrants and pass through the gain or loss onto the income statement. But this is a non-cash item. And they pay $2.2 million of interest on their debt. And the bottom line of the income statement is their net income, which is positive every year. And the reason it was so high in 2018 was they sold a bunch of assets. It was not because they were so profitable. Because as you can see, net income is higher than revenue. Unless the company passes through a non-operational gain, like the gain on the sale of an asset or the gain on one of their investments. This is the cash flow from operations section on the statement of cash flows. And the way you calculate cash flow from operations, you start with net income, and then you have to add or subtract the non-cash items on the income statement. Then you have to adjust for changes in working capital. So in 2020, they had $10.4 million of profits. Amortization is a non-cash item, so they have to add back the amortization costs. They pass through a gain on marking the warrant, so they have to minus that out on this section. When a company extends credit, they sell a product or service, then that's a use of accounts receivables and that cash flow goes down. But in the future, when the customer pays for the product or service, accounts receivables goes down and that's a cash inflow. So they had a cash inflow of $2.5 million from accounts receivables. So even though they had a $10 million profit, they actually generated over $27 million of cash flow in 2020. The top part of this chart is the cash flow from investing section on the statement of cash flows. Normally, an oil and gas company would have a ton of CapEx because they have to build out a lot of infrastructure. You can see they have hardly any CapEx, only $14,000 in 2020. That's because they're a royalty company and they don't do the actual operations. They just collect the royalty interests. Remember in 2018 they had that large gain? Here it is right here, $121 million from the gain on the sale of an asset. And it looks like every year they're acquiring more royalty rights. $1.2 million in 2018, $23 million in 2019, and $2.5 million in 2020. They added $39 million of debt in 2018 and $11 million in 2020. They paid down more debt, $44 million in 2018, $17.5 million, then $13.5 million. Since they have a consistent cash flow stream, they pay a dividend. They paid out $4.4 million in 2018, $30 million in 2019, and $11.7 million in 2020. Let's look at the capital structure. $132 million of equity, $37 million of debt. They're 78% equity, 22% debt. And I gave them the highest WACC according to Finbox. Since it's a microcap company, I thought it had a greater risk. So the WACC is 11.8%, and that's a discount rate we're going to apply to the future cash flows. We estimated 4 years of future free cash flows. We also estimated a terminal value, which is all cash flows past year 4, that's $707 million. We discounted those numbers back to today using the weighted average cost of capital. We get a value of the company of $611 million. We divide that by 47 million shares. And we get a calculated stock price of $13. They're trading at $6, so they're trading at a 56% discount. It's a buy according to the model. The average analyst projects their revenue to grow 14.5%. The way I calculated their future revenue, I grew at 14.5% for the next 4 years. And to calculate their future free cash flows, I needed to see what percent of their revenue they convert to free cash flow. So I summed up these 4 free cash flow numbers. I divided by these 4 revenue numbers. And that comes out to 65%. So I multiplied their future revenue estimates by 65%. That's how I got their future free cash flows. So it definitely seems doable considering they had $76 million of free cash flow in 2018. But a lot is dependent on the price of oil. If oil keeps going up, then they'll bring in lots of revenue and pay out lots of dividends and their stock price will go up. But if oil goes down, then the company will bring in less revenue, pay out less dividends, and their stock price will go down. Simply Wall Street is way higher than me. They're at $36 a share. They're saying the stock is 84% undervalued. 2 analysts priced this stock and one priced it at $6, another at $6.50. A SPAC always starts trading at $10. So you could see it was $10. And once they acquired this company, it looks like it went up to about $12. But ever since then, it came down. It got pretty low. It looks like below $2, but it has come up since then. Lots of buying and selling activity. Look at how big these bars are. When it's a green bar, that means the buy orders are higher than the sell orders, and the price goes up. When it's a red bar, that means the sell orders are higher than the buy orders, and the price goes down. This huge drop right here is when oil crashed, it became negative. The future contracts became negative. It's not like you received money by getting gas at the gas station. And they've been raising their dividend in the past year. It was down to 3 cents. It's back up to 15 cents. So the dividend yield is over 10%, which is 75% of their free cash flow. Their industry pays a 4.4% dividend, so they're a lot higher than their industry. And analysts are actually projecting for this company to grow its dividend to 11.4% in the next 3 years. The stock is pretty volatile. It has a beta close to 2, so it moves 2 times the market. It's gone up 148% in the past 52 weeks, while the S&P is up 31%. 52-week low was 210, the high was 658, and the stock is trading above its 50-day and 200-day moving average. Only 500,000 shares are traded each day on this stock. 61% of the shares are held by institutions and 2% of the shares are shorted. They don't need many employees since it's a royalty trust, only 12 employees. If you put $10,000 into this company when it was trading as a SPAC, you'd be at $7,900 today. That's a 21% loss. This is one of the earlier SPACs. A lot of the SPACs have come out in the past couple years. This came out in 2018. These are the biggest shareholders of the company. Eric Mindich owns 7.7%, then Freestone Capital, BlackRock, Foxhill, and another company owns 5.5%. Let's look at their financial ratios. They have a pretty good PE of 14.7. Price to sales is decent at 4.7 and price to book of 2.0, which is pretty good, better than the market median and average. They have a good return on invested capital of 12%. They can cover their interest payments 13 times. They have an ROE of 14%. They have a high current ratio and quick ratio of 1.8. They have $3.6 million of cash on their balance sheet, $9.6 million of receivables, and $1 million of prepaid expenses. So the company seems to be in decent financial shape. A majority of their free cash flow goes towards their dividend payments. As you can see here, $28 million in dividends, $37 million of free cash flow. The best way to look at ratios to compare them to companies in the same industry. I've done videos of 20 companies in the same industry as Falcon. And Falcon is a little different. They're a royalty trust, so they just collect the revenue from the companies that extract the oil and gas. A lot of companies in this industry actually do the extraction. So their price multiples are a lot better than average. They have a good current ratio, a positive ROE. The average is negative. They're a lot lower in debt than the average company, but they're a really small company, and they pay a massive dividend, 10.5%. So to summarize, I have them trading at a 56% discount. It's pretty stable, a royalty trust. There's not that much upside potential, but you should get your stable dividends each quarter. Of course, the dividends are really dependent on the price of oil. If oil goes down to $50, $40 a barrel, your dividends will be really, really small. If oil goes below $35 a barrel, you probably won't get a dividend. But if oil is north of $80, your dividend will be huge like it is now. I rank their free cash flow as 5 out of 10, their revenue 5 out of 10, and their ratio 7 out of 10. So let me know what you think. Give this video a like, subscribe, or comment below. Also, if you'd like to get a custom valuation or just support the channel, you can become a member by clicking on the link in the description below. Thanks for watching.